Exchange-traded funds allow investors to gain exposure to some exciting new markets in Australia and around the world. But before you go exploring, we have Morningstar Co-Head of Fund Research, Tim Murphy, here to tell us what every investor really needs to know. Tim, thanks for helping us out today.
No worries, Nicole.
Tim, let's start with why ETFs are attractive. What draws people to them?
The most important aspect of ETFs that makes them attractive would be their simplicity and transparent nature. Certainly, you buy an ETF, you know what you're getting up front. They're transparent, they have to provide the full list of underlying holdings on a daily basis, unlike most managed funds in Australia where there's no obligation for fund managers to do that. So sometimes when you're buying a managed fund, you might not necessarily know what's the actual investments in that fund are, whereas when you buy an ETF, you're very clear from the get-go exactly what it is that you're investing in at an underlying holding level. Some of the other things that make ETFs attractive would be their low cost structure. So relative to even index managed funds, the fees tend to be quite low or lower and very competitive. And numerous studies have shown that over the long term, the lower the fees, the more likely you are to achieve your investment goals over the long term. So given that transparent and cheap nature, the also daily trading ability, so whereas compared to a managed fund, which is typically only priced once a day, ETFs trade live throughout the day, so you can buy in and out at any time during the day, depending on how you're trying to position your portfolio. So there is an additional liquidity function there, which can be attractive, particularly to investors who are more active in how they trade their portfolios.
And is it also that perhaps they're a bit more exciting?
Potentially, yeah. I mean, there's, as I said, the liquidity is an extra function, and certainly some of the places some of them investing in could be described as exciting, certainly, but not without risk as well, let's say.
There is quite a range available now to Australian retail investors. Is it baffling?
It certainly can be, because as you say, the spectrum of ETFs that's now out there, and certainly that's increased in the last couple of years as iShares and Vanguard have entered the ETF market in Australia. So now you've got everything from broad-based markets ETFs that have been in Australia for a while by State Street, which runs their SPDRs on the ASX 200 and the listed property market. But now with the addition of iShares and some of the Vanguard funds, you've got things tracking emerging markets, single country funds like South Korea and Taiwan and China, and also sector funds like global healthcare or global consumer stocks. So, and on top of that, again, another element is the commodity ETFs, sometimes that track the gold price, for instance. So there's certainly a ever-increasing broad range of different ETFs out there available to investors. So.
Are ETFs a simple tool, or are there complexities we need to be aware of?
Because ETFs tend to track an index, they are relatively simple to understand. So if you buy any particular ETF on a given day, you should know exactly what it is you're getting. It's a portfolio of stocks that is comprised in an index, be it on a broad market, be it Australia, be it a global, be it a sector or a specific country. They should be very simple to understand, and there's no surprises in terms of what you're getting when you buy that ETF, because they're all open and out there in terms of what index it is they're actually tracking, depending on the type of ETF it is.
So, Tim, if I wanted to invest in something that was a bit more exotic, say South Korea, is it a problem that perhaps I don't know very much about that part of the world?
I think so. You certainly, when using those more exotic type of ETFs, need to tread very carefully. Great investor Warren Buffett, one of his most famous quotes is, you should never invest in something you don't understand. Certainly I would question whether most retail investors in Australia really understand what's going on in places like South Korea or Taiwan, and so I tend to question the need for the average investor out there to be buying an ETF that's dedicated to a Taiwanese or South Korean index, for instance.
So it sounds like it's really important to assess exactly what kind of investor you are before you get started.
Absolutely, yeah. You need to work out what are your goals, what is it you're trying to access, and how are you going to build that and add to that portfolio over time. If you want just core exposure to a particular market in a low cost fashion, and you're going to make a lump sum investment, then buying an ETF that tracks that particular market would be a great way to go about it. If you're starting off with a smaller amount but plan to add to that on an ongoing basis through a regular investment, then a managed fund is probably going to be a better outcome, because you won't be incurring the brokerage costs regularly that you need to do to add to your ETF investment.
Do you believe that these things are good for beginners, or are they better suited to a more experienced investor?
ETFs can be used by either groups of those particular investors. So if you're starting out, certainly buying a broad-based ETF, you don't need to go to a financial planner or anything like that. Go straight to the market through a direct broker, $20, $30, whatever the low-cost brokerage may be. Buy a broad-based, the Spider ASX 200 gives you broad market exposure to the Australian market, or some of the iShares or Vanguard funds can give you broad exposure to global markets. Certainly it was a good way to start out. We're getting broad, low-cost, transparent market exposure. But equally too, if you're a fairly sophisticated investor who likes to trade more often and wants some satellite exposure in your portfolio to some of the more exotics, then that can equally be an attractive element of ETFs for that type of investor.
So Tim, if I've already got some exposure to, say, Australian equities, would it perhaps be more beneficial to use an ETF that has some different kind of exposure?
Like any portfolio, you need to be conscious of what you've already got and what it is you're trying to achieve. That's where something like the portfolio tool on morningstar.com.au for premium subscribers comes in really handy. You add in all the types of investments across both your discretionary and your superannuation. You can see where your exposures are, and then that way, if you're looking to add money to a particular area, use a particular ETF, you can add that into the portfolio tool and see what type of effect that'll have on your overall portfolio. So,
Tim, thank you for your time.
No worries, Nicole.